Hello and welcome to another deep dive in this explainer. If you've ever looked at a price chart and just felt like the market was this chaotic mess of fluctuating lines and colors, trust me, you are definitely not alone. But what if I told you there's actually a specific, highly visual footprint that the market leaves behind right when it's about to drastically change direction? Well, today we're focusing entirely on decoding that exact footprint. We are going to master the pin bar. It's an incredibly powerful yet so often misunderstood reversal indicator. It's a tool that, when you use it correctly, can actually help you predict market reversals in advance. But, and this is a big but as you'll see, it is not a magic wand. There's a real science to it. So, grab a coffee, get ready, and let's decode the secret language of the market together. Okay, let's dive into this because honestly, this is the exact frustration that drives so many traders absolutely up the wall, right? You memorize the textbook shapes, you spot what looks like a literally flawless pattern, you enter the trade, and then, boom, the market completely ignores it, takes your money, and just moves in the complete opposite direction. So why does that happen? Why do these seemingly perfect candlestick patterns betray us? Well, the secret, and honestly the main thing that separates the pros from the novices, lies entirely in the market context, not just the isolated pattern itself. If you're trading just the shape, well, that's pretty much a guaranteed way to lose your capital. So here's our survival map for today. 1. Anatomy of a pin bar. 2. Why pin bar signals fail. 3. Trading with key levels. 4. The area of confluence. And 5. Risk management in targets. Let's start with step 1. Section 1. Anatomy of a pin bar. Understanding the shape. Simply put, a pin bar is a reversal candlestick pattern, and it's defined by a very small body and one extremely long wick on just one side. For a bullish pin bar, you'll see this tiny little body and an incredibly long lower wick. The upper wick, it's either completely non-existent or just barely there. On the flip side, we have the bearish pin bar. It's the exact opposite, a tiny body but a massive upper wick. Now listen up, because here is a golden rule you absolutely must commit to memory. The color of the candle's body does not matter, at all. A bullish pin bar can be red or green. A bearish pin bar can be red or green. It is completely irrelevant. The true signal isn't in the color, it is all in the wick. To really get why the color doesn't matter, we kind of have to look at the psychology behind the shape. Think of that long wick as a slingshot. It represents this violent rejection in the market. Take the bullish pin bar with its long lower wick, for example. During that specific time period, sellers aggressively drove the price down to the absolute bottom of that wick. But they couldn't sustain it. Massive buying pressure suddenly entered the market, completely overpowered the sellers, and violently pushed the price all the way back up to close right near where it opened. So, that long lower wick is basically a visual record of aggressive buying pressure. It's a literal rejection from the bottom. Conversely, a bearish pin bar's long upper wick shows us that buyers tried to push the price up, but immense selling pressure stepped in and slammed the price right back down. The wick is the rejection. Section 2. Why pin bar signals fail. Common beginner mistakes. Now, what's really interesting about this slide is that the difference between amateur and professional trading really just comes down to context. Picture a clear downtrend, right? And suddenly, a beautifully shaped bullish pin bar forms just out of nowhere. The amateur immediately hits buy, thinking the market's going to reverse simply because the pattern showed up. But guys, this is a low-quality setup. It's just an isolated pattern floating in the middle of nowhere with a zero supporting context. And the result? The market completely ignores the pin bar and the price just continues to plummet. But now, imagine a high-quality setup. The market is trending down, a bullish pin bar forms, but this time it forms exactly at a previous support level. If we look back at the historical data, the price had already rejected this exact level in the past. So when the pin bar forms here, we have the candlestick pattern plus the historical context. The market reacts beautifully, rejects the level again, and the price reverses upward. See? Context is absolutely everything. Section 3. Trading with key levels. Finding the boundaries. So finding those high-quality setups means you've got to do your homework before the pattern even forms. You need to identify historical key levels on your chart first. Look at where the price has gone up, hit this kind of invisible ceiling, and fallen back down. That's a resistance level. Then watch what happens when the price eventually breaks through that ceiling. Very often, that old resistance becomes a new floor, a new support level. And here is where you must become incredibly patient. You mark these boundaries on your chart and you do absolutely nothing until the price returns to them. Nothing. Only when the price hits that historical level and then prints a pin bar that visually rejects that exact boundary do you actually have a valid signal to even consider a trade. Section 4. The area of confluence, stacking the odds. All right, confluence. This is basically the holy grail of technical analysis. It's defined as the exact point on a chart where multiple independent supporting factors overlap. And honestly, this brilliantly illustrates how the professionals trade. Imagine you're tracking a stock and the price is falling. You notice it's approaching a historical resistance line that has recently flipped to act as support. Okay, that's one factor. But wait, you also draw a diagonal trend line connecting previous market lows, and you realize that the price is hitting the horizontal support and the diagonal trend line at the exact same time. Two factors. Then, right at that specific intersection, the market prints a bullish pin bar. The long lower wick perfectly pierces that intersection but fails to break it. Bam! You now have three distinct signals telling you the market is rejecting lower prices. That area of confluence, that is what gives you the supreme confidence to enter the market. Section 5. Risk management in targets. Protecting your capital. Okay, here is your unbreakable, totally mechanical rulebook for entering a pin bar trade. Step 1. You identify the setup exactly as we just discussed, a pin bar right at a key level of confluence. Step 2. The absolute moment you enter that trade, you must place your stop loss. And where does it go? Safely just beyond the extreme end of that long wick. If it's a bullish pin bar, your stop loss goes just below the lowest point of the lower wick. If the price happens to go below that wick, well, your entire thesis is invalidated. And that's okay, but you want to be taken out of the trade right then with a small controlled loss. Then, step 3, you set your profit target based on a strict risk ratio. So the crucial point is, your profit target must be 3 times the size of your stop loss, a 3x return. Let me break that down for you real quick. If you're risking $10 on the stop loss below that wick, your profit target must be placed where you will make $30. Why is this so insanely vital? Because in trading, let's be real, you are not going to win every single time. It's impossible. But with a strict 3-to-1 ratio, you can actually be wrong more often than you are right, lose half of your trades, and still walk away with a steadily growing bank account. This 3x multiplier is exactly what ensures your long-term profitability. Wow, we have covered a tremendous amount of ground today. We decoded the slingshot psychology of that long wick. We learned why trading isolated patterns is a massive trap. We discovered how to map historical support and resistance, how to layer those levels into an area of confluence, and finally, how to truly protect ourselves with a strict 3-buy risk management strategy. So I'm going to leave you with this final vital question. The next time that perfectly shaped pin bar flashes on your screen, will you impulsively trade the pattern, or will you patiently trade the context? The choice is entirely yours. Keep learning, keep analyzing those charts, and thank you so much for joining me for this explainer.